There are many credits than ever, but how can we better understand those carbon credits to make more informed decisions? This is where quality and ratings of credits come into play. Welcome, Carbon Markets Now, bringing you timely discussions with key players across the carbon market landscape, exploring policies, tools, and innovations that are shaping the future of international cooperation on climate actions. My name is Kazuhisa Koakutsu, Kazu, Director of the Article 6 Implementation Partnership, known as A6IP. So A6IP supports countries in the implementation of carbon markets under the Paris Agreement by building capacity, facilitating knowledge exchange, and promoting carbon markets that are more transparent, robust, and aligned with global climate goal of net zero by 2050. In this first episode of Carbon Market Now, we are exploring carbon credits and rating agencies. This is an emerging subject that is taking the center stage to address challenges facing credit quality in the broader carbon market. As international carbon markets continue to evolve and carbon credits become increasingly incorporated into both domestic and international regulations, one question is how to assess and evaluate carbon credits that are fit for purpose. So joining us today is Allister Furey, Chief Executive Officer and co-founder at Sylvera. Thank you very much for joining. And also Sebastien, Chief Innovation Officer and co-founder at BeZero Carbon. Both companies are leading players in shaping the future of carbon credit ratings and bringing innovative services in this space. And I really great to be honored to have both of you, again, the co-founder of very important and instrumental services that are providing in this carbon market. So thank you and welcome joining both Allister and Sebastien. First, we will unpack carbon credit quality and ratings, then spotlight the perspectives and initiative of our guest. First, let me start by providing a little bit of background of this topic. First, maybe you have heard so-called high integrity carbon market. This is instrumental to ensure carbon market accelerate actions towards net zero emission by 2050. To support, enable those efforts, in 2023, G7 ministers in meeting in Sapporo in 2023 has endorsed so-called the principle of high integrity carbon markets. This lays out three important components of the integrity of carbon market. One is supply side integrity. This is more related to the carbon credit quality. And the second is the demand side of the carbon market. This is more of how the carbon credit will be used towards net zero by 2050. This is more like a buyer's perspectives. And also the market integrity. This is more providing the transparent carbon markets, which provides what kind of carbon credits are available and used in the market. So for this episode, we will more focusing on the supply side of this integrity. So just to give you a little bit of the background, what is supply side? And of course, today, later on, both Allister and Sebastien can provide you more about this aspect. But this is more related to how the credit is representing real, additional, and verified emission reductions that are contributing to the achievement of net zero by 2050. So this means that the credit that representing emission reductions are ensuring more robust certification standards, more monitoring, and transparent governances, and how those are promoting sustainable development. And also, this will need to ensure there is no environmental, negative, social, economic impacts are identified, and also disclosed, and most importantly, addressed, including human rights. So these are the important elements of how the supply of the credit needs to be ensured. And I understand that rating agencies and also the quality standard can also provide those information. So with that brief introduction, first we will now ask our speakers for their insights. So first, there is one big picture. So first, Sebastien, could you please share about BeZero and help us understand what characteristics is defining the quality of a credit? So, Sebastien.
Absolutely. And thank you so much for inviting me on to today's webinar. So, yes, I'm Sebastien Cross. I'm Chief Innovation Officer and co-founder at BeZero. And BeZero, as you said, we're a carbon rating agency. So what does this mean? Well, I think you highlighted extremely well, Kazuhisa, in your introduction, the different factors that we have to take into account when assessing carbon projects. But I think you're split there between the carbon performance or the greenhouse gas performance, and then all the other potential benefits that projects can bring is really, really important, because what the market is built around, what buyers are looking to purchase, is carbon credits. Every single credit is a certificate saying that a ton of carbon has been reduced or removed. And the risks around that performance are really, really important to understand if buyers are going to make informed decisions. And then you've got all the other wonderful things that the carbon market can fund when thinking about co-benefits, both the social impacts, the biodiversity impacts, and others. But it's that carbon performance that we focus on at BeZero, primarily through the provision of carbon ratings. So what is a carbon rating? Our ratings run from AAA down to single D, looking at the likelihood that a credit achieves a ton of carbon. AAA being the highest, single D being the lowest, and everything in between. What do we look at in order to assess that? There's three key risk factors. Additionality. What's the likelihood that the project is only taking place, the project activity is only taking place because of the carbon project itself? Are there other reasons why this activity might have gone ahead? Carbon accounting. What are the calculations behind the number of credits that are issued? What are the assumptions? What's the robustness of the data? And then permanence. What is the likelihood that the activity that is leading to the carbon being reduced or removed remains so for the period of time that's been committed to? And in many cases, this can be decades into the future. And so across those three risk factors, BeZero, we're a team of close to 200 people, about half of them scientists of some sort, coming together to try and interrogate all the different activity types that feed into the carbon market and the issue credits. Through those key risk factors, we can produce ratings that give buyers and others in the market an idea around the carbon risk. We also then look at the other benefits that projects achieve. So thinking about the co-benefits, we look at SDG claims. We also look at whether projects are achieving their safeguards, ensuring that there's no net harm caused by the projects. It's also very, very important, but it's also important to stress that the rating is not a mixture of the two. The rating looks at the carbon element, and the beyond carbon benefits are assessed separately. But the rating is a pure metric on the carbon performance. And it's down to buyers as to how they bring those two things together to get an overall view of quality. Some people are willing to trade off higher risks on the carbon side because of the benefits the projects can bring, whereas others, will only want to look at the carbon achieved and ensure that they have the highest chance of a credit achieving a ton of carbon.
Thank you. Thanks, Sebastian. That's very great insights into what kind of factors that you are looking at. So very much thanks for your explanation on elaboration on that. So now I'll turn to Allister. So could you please provide background on Sylvera and how Sylvera has seen rating interact with quality? So Allister, please.
Thank you, Kazuhisa, and thanks for hosting me and on this webcast. I think it's a podcast. I think it's a great initiative. So yes, I'm Allister Furey. I'm one of the co-founders and I'm the CEO of Sylvera. Sylvera, we've been running somewhat over 5 years now, based across the world: London, Singapore, Tokyo, and New York. And we are a ratings agency, and we also provide tools to help actors operate in the market and underlying data sets. As a rating agency, we generate lots of data, we clean lots of data, and that data can be useful separately to the rating. So yeah, how do market actors use a rating, and how do we produce them? So the nice thing about ratings is all the agencies are very well aligned on those pillars that Sebastien laid out, which are inherited from much of the work done under the CDM. And then the question is, how do people use this ratings, and how they produced? So typically, there's a separation between the sets of tests that you need to produce to operate, to test against those principles: additionality, carbon accounting, permanence, and then the production. You can think of it a little bit like the design of a car versus the manufacturing of a car, or the design of a ratings framework and the producing of ratings associated with that framework. So it's important from the user perspective that the production of the rating is very stable, it's as deterministic as possible, and that requires a set of tests to be designed that adequately tests against those characteristics Sebastien so clearly laid out. So we design what we call frameworks, which are basically sets of rules for each project type. And we do that in consultation, not with our own internal science and policy teams, but external ones. We publish that draft framework for consultation, and then we start to test the delivery of ratings in what we call our production system. So how we take raw data, apply those tests, and get it to an answer. Once we elicit feedback from the market, we set the parameters, or how the frameworks operate. We kind of lock the framework then, and we start the production process. And at that point, when we look at a new project, we start to take inputs, the data that the project might have published, and external data, which we can use to verify or cross-check what the project is saying. And we clean that data. There's lots of errors and inconsistencies, and the structure of the data is very messy. We produce an assessment in draft. We run some quality assurance, and any things we discover on a quality issues, inconsistencies, then get to use them to improve the production system. And then we publish the rating first to the developer. We give them a right to give us additional data, and then we start to maintain coverage of that project updating when new documents come online, updating when new things happen on the market. And the actors that use this really split from demand side and supply side. So originally it was the interest was very strongly from the demand side, and their problem was understanding relative quality, and especially as it related to reputational risk. Once a premium became established, and the ratings now correlate with a strong premium for a price premium, then it becomes a very clear value proposition for the developers who want to secure long-term offtake agreements. They want to secure financing, and they want to demonstrate the underlying rigor, the quality of their projects. And there's a use case on the supply side. So you see the full set of actors in the value chain, supply, demand, and actually the intermediaries benefit from this very standardized data, and actually having multiple providers of that data that can be corroborated and cross-checked. So it's a good thing that there's a diversity in ratings. So hopefully that covers the production and the use of the rating.
Thank you very much, Allister. And just starting from the Sebastian's point about ratings, qualities, and additionality, accounting, permanence, those are three very important. But same time, looking at this safeguard and also promoting SDG that provides a kind of quality ratings and the components. But at the same time, Allister also mentioned about the data and also testing, and also creating a framework how to kind of apply those principles into the real action. So now I also wanted to move a little bit more on the substantive part, which is Sebastien. So if you could provide example of the projects that develop quality projects with high rating, I think that could provide a little bit clear picture of what it looks like. So Sebastien, please.
Yeah, absolutely. And I'll caveat my answer by saying that I'm not endorsing any one project, because that would obviously be not be appropriate as a rating agency. But I guess to give you some interesting examples, I guess firstly to contextualize it as Allister was saying in his answer, we've seen a positive correlation emerge between ratings and pricing in the market, which is great. It's sending a really important signal to the market, and it is incentivizing projects to want to develop higher rated credits, which means that ratings are being used earlier and earlier in the kind of project life cycle. And we see this because our ratings are made publicly available on a number of marketplaces. We see this reflected from our marketplace clients, who tell us that increasingly market players are asking for a BBB rating or higher. There's both that positive correlation emerging, but also a bit of a cutoff between the top half of the rating scale and the bottom half. That's not to say there's no demand in the bottom half, but there's definitely a bit of a step change there. But then looking at specific subsectors, even in subsectors where the average price point is a lot higher, for instance in biochar, we've seen a number of projects now who have come to us to get a rating because they believe they're taking a higher integrity approach than other biochar projects. It's a sector that's seen a huge growth in the number of projects, and feedback from those projects such as Novo Carbon has been that they've been able to achieve a higher price point even above their competitors, with the average price point for biochar being north of $100. So even in that high price point, ratings are acting to differentiate within a sector. Likewise in sectors like cook stoves, which has been around for quite some time. There's obviously been a number of issues historically with both measurement and additionality. We had one project, EcoSafi, get a rating because they believed they were taking a more robust approach to their measurement than their competitors. That was reflected in the rating that they actually ended up achieving. They were the first A-rated cook stove project, and were able to achieve a price that was 5 or 6 times the kind of average price for a Cookstow project in the market at the time. But it's not just, I guess, spot demand that the rating is encouraging as well. It's also in the pre-issuance space. Offtakes, there's a big focus on securing offtake agreements, because you can use that potentially to attract additional finance, potentially even debt finance. And so an example there being in the forestry space, there was a US IFM project that recently announced a large forward purchase from Microsoft that came off the back of some of the due diligence work that we provided to Microsoft. So there's examples across all different subsectors where ratings are making the key difference in how projects are able to attract demand, attract higher prices.
Thank you. Thanks, Sebastian, for providing such example of the some specific sectors, and also those are also supported. And I also find a very interesting kind of interrelationship between those who are demanding and also those who are supplying as also aligning with those demands. So I think really the quality of the ratings really kind of providing the really great kind of a feedback process to which I'm sure the market are also increasingly more looking for the high quality products, and also something contributing to net zero. Okay, so for, the last question in this set of the segment is to Allister. So Allister, maybe based on what we have building on the discussions, could you please elaborate on who is likely to use carbon ratings and how?
Yes, thanks, Kazi. So you have the. I mean, I maybe you can be relatively brief on this. I think it's been covered somewhat by Sebastian's answers and mine. But you have a clear use case, or the most kind of textbook use case is really from the buy side actor, and they are trying to do 2 or 3 things. One, ensure the climate impact of the credit is being solved for. So that's the critical need. If the utility of the credit relates to the underlying climate impact, then having a third-party independent test is very helpful, because the buyer is paying money to have some impact, and it's essential to that is true. So there's been numerous cases in the past where that's not been true, or there's been some kind of impairment. So just providing that test independently can actually be critical in unlocking budgets, ensuring that government governance principles are upheld, and that can actually just tie into some of the organizational risk management practices. So just enabling the buyer to act and ensure that their goals are being delivered against. The kind of flip side to that is risk management. So ensuring that a buyer isn't spending, which could be a large amount of money, and this could be a sovereign buyer as well as a private sector buyer, that there isn't some risk that will manifest itself reputationally. For example, I think you mentioned like community, the projects operate in real world communities. If their consent hasn't been appropriately sought, if the benefits of the project are not being shared with them, then this can come back and manifest itself in a reputational risk. And then I think the third one from the buyer perspective is really value for money. So all things being equal, people will tend to pay the lowest price. And historically, the buyers have not been able to test if all things are equal or not. So the market has been really one defined by claims, and the vendors have relied on information asymmetry. The vendor knows more than the buyer, and you see very large spreads historically. So for the same underlying quality, the same attributes. So in Seb's example, biochar could be cookstoves. You see very large spreads for the price differentials for the same credit quality, which basically suggests that somebody is taking advantage of some information gap that can be closed with the use of ratings. So that's important. And then, I think Sebastien actually well covered the supply side. What the projects need to do is typically two things. One, secure somebody who is willing to purchase the credits, ideally on a long-term basis. So in the same way that a power project would seek an off-taker for the power, somebody that would be willing to purchase power from whether it's renewables or fossil fuel, knowing there's a buyer and there's a price mechanism or some price that is somewhat reliable, might be required for financing the projects, which and that becomes a second critical use case. Understanding the likely cash flows of the project. Will the project cover its costs? Will there be some reasonable profit or some return for the investors who are having to take risk? That becomes critical. So you also see cases at the moment now where we're being asked to provide diligence on projects for any of the three counterparties involved at the early stage of the project. It could be a fund or a bank who is investing in or lending to the project. It could be a corporate, say a tech company, who is looking to establish like a long-term purchase agreement. And their risk management and value for money becomes really important because you're locking in a commitment over a number of years. And the developer, who basically needs the other 2 points of the triangle to be solved for, they need a buyer and they need the investment in the project. So each one of those three actors, they have a different perspective and a different set of needs they're trying to solve for. But the assessment of quality, the rating of the project at that early stage is really important.
Thank you, Allister, to pointing out the how those rating and quality information could be used, particularly in terms of how to manage those risks. Maybe those risks may be depending on who will be involving, even like a buyer's context or developer's context, maybe trader's context, and there's also information related to the price that also related to those projects. So I see there are a variety of kind of application of this quality and rating information to be applied. And also, I first then moving on to the next topic of the another topic of another and important topic of the Article 6 of the Paris Agreement. As you also pointed out, this is related to the use towards the so-called national determined contribution under the Paris Agreement by the parties to the Paris Agreement, mostly the government, as well as other international mitigation purposes, such as the aviation's offset scheme called CORSIA. And also countries are increasingly using not only just achievement NDC, but also looking at more beyond the NDC achievement, like achievement of the net zero by 2050. So the Article 6 provides the framework, how those counted towards those each the cases for the use. So first, I'd like to ask Allister what has Sylvera learned about how countries and companies can navigate this emerging system of Article 6 of the Paris Agreement more effectively.
Thanks. It's a great question. And I think the first thing to say is that the considerations we talked about, which were really principally in the context of voluntary markets, almost apply completely also to Article 6 credits. So you have questions of quality with those underlying pillars. They're the same ones. and you have questions about risk and about price and value. They also all apply in Article 6. There is unfortunately another layer of complexity. I think you used the word emerging. So I do think that's one of the challenges is the way that the COP process has been moving, the way that the market is being established. It's more nascent than the VCM. So the first thing is basically tracking all of the changes, because they will link very closely to the availability of credits and the price and the contractual mechanisms and a number of factors. So firstly, staying aware of the dynamic nature of the space. Probably just worth mentioning, I think that we do see a slightly different balance of concerns in the voluntary context and in more in compliance or more regulated schemes with like more sophisticated governance, where the utility of the credit, the ability to use it, is governed by a certain set of tests or eligibilities. The relative weighting of the rating versus do the credits tick the box is lower. So you do see lower price quality correlations in IFM markets, for example, where there's a kind of a floor price set by the California ETS, for example. Having said that, the underlying ratings drivers are still very dynamic. And in Article 6 projects, we did our first assessment of an Article 6 project, and we've done several since well over a year ago now. And you observe a similar distribution in quality. And that's a function of the fact these project activities are very diverse, very complicated, and context sensitive. And it's possible to configure projects more conservatively or more aggressively. So that property is true also in Article 6. Aside from quality, though, there are a broader set of attributes. And again, you have a demand side perspective and a supply side perspective. But you do have this critical question of utility. Will I be able to use this credit? And that is a function of the letter of authorization and the subsequent issuance of the corresponding adjustment in Article 6. So then, aside from the underlying credit quality, you do have a separate set of questions. Will I actually be able to use this credit? And you do see some divergence in the LOAs, the letters of authorization that give the ability to use credits in this context. And there is a question at what portion of those will actually be realized in the corresponding adjustment, which to some extent is a function of the progress of that nation state, the issuing state, towards its NDC, and also towards the opportunity costs, political factors, and the market price. So you have a whole set of different factors that need to be tested or brought to bear when thinking about Article 6. Before I just close, I think for the nature-based sector in particular, you see again a set of evolving science and the way that the carbon stocks in both managed, as in agricultural systems, and natural systems, which would be forest or grassland, peatland sometimes, the science is dynamic there. So similarly to the kind of regulatory environment, there's movement on the science side. So we end up doing lots of work on the assessment of carbon stocks in these systems, which turns out, when you look hard, to be quite different from the historic estimates. The good news is there typically tends to be more carbon in those systems, but this creates another question about the NDC of the country, and it's something that we're seeing both issuing nation states and the buyer states become more aware of the need to further assure the underlying stocks and fluxes, the changes in natural systems, maybe over and above what had been done historically, just given the amount of money and the climate impact at stake.
Thank you, Allister. I think you mentioned about the kind of relationship between the voluntary carbon market and Article 6 can share the similar or almost same kind of underlying framework, which I believe kind of related to what Sebastien already mentioned about like additionality, accounting, permanence, and also sustainable development, and addressing the safeguard. But same time, I think there are kind of additional component related to the Article 6. Allister, you mentioned about several topic, but I like to Sebastien to provide a little bit more about elaboration on what is additional consideration on top of the kind of core carbon rating that should be considered for the Article 6 context. So, Sebastien.
Thank you, Kazuhisa, and yeah, it is a really important question, and move to build on some of the things that Allister was saying in his previous answer. Yes, exactly. It is early in terms of the implementation of Article 6. We're still trying to figure out exactly the dynamics, but the Allister's triangle is turning into a square effectively, because the three players that you have to add governments or countries into that then to make it complete, and it does. It introduces additional complexity and additional considerations. But if we just break down, like, what is a country doing when it authorizes a credit to be correspondingly adjusted? It's saying that this credit goes above and beyond my NDC. And that is obviously a dynamic assessment, because it's the ongoing performance against the NDC, and the credit is then adjusted at the end of an NDC period. And so there's two elements to consider in there. Firstly, through the lens of the existing ratings frameworks, obviously additionality, one element of additionality is policy additionality. And traditionally, when we've looked at this in the VCM, it's, does the government just have other policies in place that mean that it might be undertaking this activity anyway? Well, now with the Paris Agreement, with NDCs, you also have to formally look at, is this activity part of a country's unconditional NDC? Because if it is, they are saying that they will undertake this activity without any international support, and it's something that the government should be doing themselves. And so that is questioning the additionality of a project. Now, because of the way that NDCs are defined, it's not clear cut. Even if a government says that it's going to be doing some part of an activity, it's not always defined as a boundary of how much they will do themselves versus what is above and beyond. So it is it's a tough assessment to make, but it's one that is already captured where we can through the existing ratings. I think then the interesting part that we're being asked for a lot, both by buyer countries and indeed some private sector buyers who are looking to purchase Article 6 credits, Corsair being the prime example, and airlines. If the credit is correspondingly adjusted and it is going above and beyond the NDC, then obviously there's a question as to how robustly the NDC is reported. Can I understand everything that's captured there, and can I understand the ongoing performance? Because while it's not formally written into the Paris Agreement that a credit is invalidated if a country underperforms its NDC, it's kind of going to become the equivalent of reputational risk in Article 6 markets. If you've purchased credits from a country that doesn't achieve its NDC, what is that saying about those credits? And so buyer countries are asking us to look at, does the NDC capture all of the emissions and carbon stocks in that country? Can I clearly see what the base year is, what the target is, and then how they're performing against it? What is then the governance in place that gives credibility to the authorized credits and that they'll be correspondingly adjusted. And so it introduces an additional layer of complexity whereby the project level accounting has to marry up with the national level accounting to all be brought together into this picture of integrity. But I think, again, if you look at what ratings have achieved in the voluntary market, there's a real opportunity for ratings to do similar in Article 6 markets, whereby we provide a mechanism that incentivizes a race to the top. You can incentivize countries to publish better data, to be tracking their NDC on an ongoing basis, and therefore to be getting more buyers, more demand for credits they're looking to give authorizations to, and hopefully better prices. So I think it's an exciting time from that perspective for the development of the market.
Thank you, Sebastien. I understand, of course, this is still emerging topic and something we have been accumulating experience and something doing more information to be more available. But I clearly see the areas like additionality, especially like a policy side or regulatory side, and also related to the NDC, like a conditional or unconditional, and relation to how the NDC being performed and in the reporting. So I think those areas, definitely I see more information in the more country basis is needed, and maybe that could be incorporated in the rating. Okay, so I move on to the next third segment, which is we would like to more spotlight on each company's the actual initiatives and also services they are providing. And let me just start from Sebastien. And I'd like to ask, please share about your recent experience. I understand that, of course, as a rating agency, you are looking at various markets, various topic. But I understand that there is some kind of experience gained. For example, like Bursa, Malaysia, National Stock Exchange of Malaysia, that has been also growing in their own context, and Kuamut Rainforest conservation projects, and that has been also receiving some attentions. So if you can kind of provide some of the experience and also initiative that BeZero is providing. So Sebastien, please.
Of course, and again, I will caveat it in saying that this is not an endorsement of the project. I'm just going to repeat the factual experience, and all of this is publicly available as well. But so Kuamut is an improved forestry management project in Malaysia. Is a big project, issuing over 500,000 credits a year, I think. But it's certainly in the hundreds of thousands. IFM is an interesting subsector, as Allister alluded to in his previous question, there's an interesting interaction with compliance markets in some parts of the world, but it's a hard project type to assess because there is a commercial element in there. So it's not like ARR where carbon financing tends to make up a large part of the overall revenues. You have quite often commercial elements to consider. And so, it's a subsector where we find traditionally projects are rated in the bottom half of the rating scale for those that we'd rated to date. But this project in Malaysia felt like they were taking a very high integrity approach. They were going above and beyond the methodology and what it was requiring them to do in a number of cases. They were also using some of the latest techniques in regards to LiDAR and machine learning. And so they initially came to us asking for a pre-issuance rating. So we were rating the project was actually not at the design stage at that point. It was in the implementation stage, but was yet to issue credits. They wanted a pre-issuance rating to show that the techniques they were applying and the overall approach they were taking was robust, and they wanted to use that in order to go to both buyers and investors to secure demand in both factors. The pre-issuance rating we usually do on a private basis because it's based on private information. In this case, the project developer chose to publish the pre-issuance rating because they were going on to issue credits on Bursa Malaysia, the exchange. And so the rating was then used as part of that process of building demand, building a book to auction through the exchange. It enabled them to get a price that they were happy with, and obviously to build some interesting kind of coalitions to do so. And then the rating passed from being pre-issuance to post-issuance, or ex-ante to ex-post. Once the credits are actually issued, the rating then becomes publicly available on our platform and all of our partner marketplaces. And that project has continued to see strong demand for their credits. There's I think over 2/3 of them have been retired to date. But it also shows how the rating tracks the project through its life cycle, and so it continues to give confidence not just to new buyers, but existing buyers who have offtake agreements in place, or indeed investors in the project. A rating is an independent third-party assessment that is tracking the project on an ongoing basis, so you can see that ongoing performance. So anyone who has exposure to those credits, even people who have retired the credits, can use it as a proof point to show that it continues to perform as expected.
Thank you, Sebastian. I think that's the pre-issuance rating is very interesting, and I'm sure those are very kind of important indicator and also information to the potential investors and also those who are looking for the credits in certain sectors. So thank you very much for sharing those experience. So I also move on to the Allister. About also the initiative which Sylvera is looking at. One of them is the work with JCM. JCM is Joint Crediting Mechanism. This is the initiative from the Japanese government operating the bilateral mechanism, and also in line with the Article 6 implementation. So how might Japan's approach influence broader market development in Asia and beyond? So Allister, please.
Yes, and I'll try and be brief on this. We started assessing JCM credits last year. I think again there's a theme here. There's quality that varies from project to project. In some cases, that quality can be quite high. So it's just a point to note. Also, probably worth noting, there is a distinction in the JCM between government-backed projects and private sector ones, or the one there is now, which is a large red project, but does account for the majority of the credits. So you have one mega project, private sector backed, and that's enormous. So there is some kind of a nuance there in the distribution of projects. In terms of the broader approach, I think Japan has a lot to offer. Japan has led on the establishment of bilateral partnerships, for sure, and the negotiation around LOAs, which is a huge challenge for buyers, I think is already and will continue to influence the way the market develops. So having that best practice established is very, very useful. Another thing that I think Japan has been particularly good on is the infrastructure around registries, tracking of projects, etc., where Japan is particularly experienced. So, I think maybe one more point is that JCM is rather transparent compared to other national systems. There's a lot of project information available, and that is sets a bar, frankly, for other systems. It would be good to see all national systems as they emerge to emulate those characteristics, the rigor around the registries, the transparency, and that would be very, very helpful. So I think in summary, like the demonstration of best practice, I think is material, not just in Asia, but globally. And I think that final point to note is the way that the JCM often brings in private sector actors for more of a kind of mutual economic benefit in some cases. So then this is maybe a more scalable way of addressing a broader set of levers in industrial decarbonisation than like the large forestry projects that you typically see. So whether it's the upgrading of grid infrastructure, of energy storage, of industrial processes, what Japan's done is bring its industrial strengths to bear in facilitating decarbonisation in the partner projects, and that won't be the same for all geographies, for all jurisdictions, but that kind of general principle of mutual benefit, bringing the unique assets the Japanese has to bear, that I think also provides a model.
Thank you very much, Allister, for providing all those examples of some of the specific mechanism. And in this carbon market now, we also try to cover those recent updates from different initiatives, from mechanisms in our future episode. So hopefully we can also take up some of those examples in the more detail. But thank you very much for these experiences. And I move on to the last segment, which is about the broader perspectives and the future outlook. And I see that we have a little bit overpassed the time, but I do really appreciate your insights into how you can move forward with this rating and quality of credit services to broader Article 6 architecture, as well as the carbon finance mechanism in the various jurisdictions, including voluntary carbon markets. So I'd like to ask same question to both Sebastien and Allister. And of course, you can reflect some of our discussions for our future outlook. So first, Sebastien, please.
Yeah, thank you. And yeah, thanks again for having us on. It's been a fantastic discussion. I think, as I said in my previous answer, Article 6 is at an exciting point in time because we are figuring out the actual implementation of it today. It's a huge opportunity, right, for supply side countries to be benefiting economically from their climatic outcomes. But we have to get the market structure right to see its scale and to see buyers be willing to engage in it and have the confidence to use credits as part of their own targets. I guess I'd characterize the role of ratings there across the two sides of the supply side on the demand side. On the demand side, ratings are part of the due diligence that countries want to do. Right, they when they're procuring credits, want to they need to be happy that the credits are achieving the carbon outcomes that they're subsequently claiming in their own use of those credits in their targets. We're having some really interesting discussions with countries who are currently considering the use of Article 6 in future targets, the EU being the case in point, where you've seen a number of countries come out and discuss whether Article 6 credits could make up part of 2040 targets. They want to have a mechanism that allows them to ensure that the credits achieve the highest possible carbon outcomes. There's a huge focus for them in that discussion as to whether it should be used in the NDC, and ratings are a tool that allow them to do that, allow them to assess their own risk tolerance and then place that on the scale that the ratings offer. But then on the supply side, your ratings can help the supply side achieve better economic outcomes from using Article 6. We've seen the voluntary market, as has been discussed, this positive correlation between ratings and pricing emerge. I think we're going to see the same in Article 6, and indeed we are, but not in as many kind of cases of public data points. But in the challenge for the supply side is choosing which projects to give authorizations to and ensuring that those projects achieve high enough prices, that the country itself is achieving sufficient tax revenues to feed back into achieving their NDC, and that they're reporting then their NDC performance in a robust, ongoing way. ratings are the external third-party assessment that enables those taking that high-quality approach to show the market that they're doing so, and it brings more potential buyers into the market in future. And if we get Article 6 right, if we enable market mechanisms to actually make a meaningful contribution to net zero, we stand a much better chance of actually seeing our emissions reduced, but also building up the removal capacity that we know we need to globally. So we see a key role for ratings in the emerging market structure for Article 6.
Thank you, Sebastian. So I move on to Allister.
Thank you. So some great points there from Sebastien. I think maybe just to add rather than duplicate, I think the bridge to this is definitely the climate impact. So as there's a great, and it's great to see the focus on that rigor of making sure that the projects, the resulting credits, have their climate impact. I think what you'll see from that is maybe a greater price when the true price of a true activity is it has to be covered. Then you do see a kind of more buyers come in because in a way they're more willing to take that risk, but also a tightness in the supply. So we what's really important is if somebody is contracting with a project, that the credits come to be. So when we assess a project at the pre-issuance stage, a lot of the work is really around whether the credits with the activities will deliver the volume of credits that are expected, so the yield of the project. Typically we see most projects under-delivering quite significantly, and that alone, that uncertainty, is maybe one of the next kind of bottlenecks to capital and participation in the market, because it's difficult to get financing for a project when the output of the project in terms of its cash flows are uncertain. So we've done a lot of modeling on the yields of different project types and the underlying drivers, and that gets fed back on a per project basis. So when we see best practice could change the outcome of the project, we'll always share that with the project, and then they typically course correct at that earlier stage. And often they might issue fewer credits, but there'll be more buyers, and then there's a greater reward for being conservative in terms of the project actually does better economically than you might think from the volume coming out. And then you do have this in the Article 6, future converged carbon market context. You do have a rather kind of patchy outlook for prices, because certain projects, certain credits will be usable in multiple schemes. So obviously, if there's an adjustment available for certain methodologies, you'll be able to use that project for CORSIA for certain vintages. And where you have that multiple uses, the credits are typically going to be sold into the higher price use case. So you do see these questions where changes in the participation of CORSIA might have a knock-on effect in certain ETS schemes or Article 6 kind of markets under 6.2. So that becomes really important. So we've, for some of our sort of banking clients or in the energy sector as well as government, we've done a lot of work modeling out how the kind of tagging of each credit relates to the underlying, as in what can I use this credit for? Which cases, in which markets could I use this credit? How that relates to price. And we've seen entities basically say, it's fine, we'll just buy credits of type X, and we know that they are like they're likely to be 3 times more expensive than they have budget for. So resolving those uncertainties as early as possible. Again, well, they can go and get the budget if they know 2 years ahead of time, but not if they know 2 months ahead of time. This kind of information, like bringing it to the various different actors, I like the 4 corners of the square, can basically fewer surprises, greater certainty on quality, on yield, on price, on how these different markets are converging, can unlock all of the actors to kind of proceed with more confidence.
Thank you very much for both Sebastien and Allister for sharing those perspectives, as well as Article 6 opportunities and also future outlook. So I very much appreciate both of you to providing very rich insights in terms of carbon rating and also credit quality, how that interact with Article 6 and also broader ecosystem of carbon markets. I also wanted to make mention about the climate impacts that Allister just mentioned. I think those are really related to the price, as well as the points also made by Sebastien, authorization and removals. I think those are all important areas related to each other to really create more impacts in the context, in the future broader context. So with that, I wanted to just to say thank you both, and carbon market and also this credit rating played an important role in promoting supply side integrity, and we also learned this also related to demand side and building trust in market that we are standing, and see how ratings can influence and encourage carbon projects to strive for more high quality carbon mitigation outcomes, which is also very instrumental in promoting this market to be robust and also achieving net zero target by 2050. So to learn more about A6IP and BeZero and Sylvera, please visit our website, linked in the comments section. If you enjoy this video, please like and subscribe to Carbon Markets Now and follow A6IP for more insights into evolving world of international carbon markets. And thank you for joining today, and see you for the next SPO. Here is the latest carbon market updates. The first one is the 16th Article 6.4 Supervisory Body meeting. This is what is called the Paris Agreement Credit Mechanism. So the supervisory body has adopted important new standards on 16th May this month, including a standard on setting the baseline in mechanism methodologies and standard on addressing leakage in mechanism methodologies. So congratulations to the 6.4 supervisory body. And the second one is the updated carbon market regulations. And also another congratulations to Zimbabwe. They have updated the carbon trading regulations, which includes Article 6 authorization arrangements, as well as criteria for Article 6 projects. And the third one is the new bilateral cooperation under Article 6.2 guidance. Here we have two new updates. One is between Switzerland and Kenya, they have made an implementation agreement. And also Singapore and Rwanda, they also had made another new implementation agreement. And again, congratulations for all the countries. And the fourth one is about the Article 6 reporting updates. So we have a recently publication of Article 6 technical expert reviews reports and agreed electronic format submission. So the latest Article 6 technical expert reports contains first initial reports, and the Article 6 technical expert review reports also provide helpful recommendations on areas for improvement of consistency with reporting requirements, as well as identifying capacity building needs in consultation with the country. And agreed electronic format, which is the annual information submitted by parties, was submitted in 2025 this year by Thailand, Ghana, Vanuatu, and Guyana. So again, congratulations for all 4 parties which has submitted those reports. And again, this is the first time that we see those reports being submitted. And last piece is the voluntary market updates. So the UK government consultation on voluntary carbon and nature markets, raising integrity. So the UK government opens consultation on the proposed policy and governance framework for the integrity of voluntary carbon and nature market credits. And the ICVCM, the Integrity Council for Voluntary Carbon Market, approved 3 cook-stove methodologies from Gold Standard and BeZero, and also approved household biodigester methodology, again from Gold Standard. And this is a new methodologies for approval, and this is a new market development. And the last but not least, the VCMI, Voluntary Carbon Market Initiative, released new Scope 3 Action Code of Practice in April last month. And again, congratulations for the new updates of this development. And we look forward to see the new progress in this area. So that's all for this carbon market updates, and looking forward to providing more new updates in the next episode.